Welcome back to Talk Tickers, where we break down the earnings calls that are moving the market. And boy, did this one move the market. Today, we are diving deep into Peloton's Q2 fiscal 2026 results. This was a wild quarter where the company's amazing progress on profits ran smack into a brick wall of slowing demand. Before we even get into the weeds, let's just start with this number, 25.7% down in one day. Oof, this number right here tells you pretty much the entire story of how Wall Street felt about this report. I mean, look at this. The stock just got hammered. It went from nearly $6 a share to an 18-month low. This wasn't just some minor sell-off. It was a full-blown panic, and it really signals that investors think this company is at a major crossroads. All right, so here's how we're going to break this all down for you. First, we'll talk about that market verdict. Then we'll dig into the numbers, the good and the bad. We'll get to the absolute core of the problem, unpack the guidance that truly terrified investors, and then we'll wrap it all up with our official call on the stock. Okay, let's get right into it. The thing is, this earnings report had two completely different stories playing out. The market took one look at both and decided to completely ignore the good news and laser focus on a much, much bigger problem. And this slide, this captures that conflict perfectly. It's like the company has a split personality right now. On one side, you've got this awesome margin story. I mean, look at that. Gross margin is way up, they're generating cash, the cost cutting is actually working. But then you look at the other side and yikes. The demand story is just falling apart. Revenue missed, and they're actually losing members. So let's dig into the actual headline numbers that created this whole mess. Right out of the gate, it wasn't pretty. Peloton missed on earnings per share, and they missed on revenue. That top-line number, down 3% from last year, really set a negative tone for everything that was about to come. A miss is one thing, but a miss when you're also shrinking, that's a bad combination. So you have to ask yourself, why did they miss on revenue? Now, this is the really fascinating part, because this wasn't just a soft quarter. The miss came even though they just launched a huge hardware refresh, which makes the reason for the miss so much more important. And the answer, well, it's probably not what you think. It wasn't about failing to attract new people. Actually, management said sales to new members were pretty much what they expected. No, the problem was with their existing loyal customers. And boom, there it is, right from the horse's mouth. This is the whole enchilada. Their most satisfied, diehard fans, they just aren't upgrading their bikes and treads. It's kind of ironic, right? The company made such high-quality, durable equipment that people don't feel a need to buy a new one. It's a classic case of being a victim of your own success. Okay, so the quarter itself was problematic, for sure. But what really tipped the scales and sent the stock into a nosedive? Well, that was what management said about the future. Just look at that guidance for the next quarter. They guided revenue to a range that was way, way below what Wall Street was expecting. They also had to trim their outlook for the entire year. This was basically them telling the market, hey, that demand problem we just talked about, it's not going away anytime soon. And if all of that wasn't enough, they dropped another bombshell. The CFO is leaving. A surprise departure in the C-suite right in the middle of a tough period, that just screams execution risk. You know, they actually raised their profitability target for the year, but the market could not have cared less. The message was loud and clear. Right now, growth is king. And if you don't have it, we're selling. All right, so let's put it all together. After a quarter like this, what's our call on Peloton? Where does the stock go from here? Yeah, we're initiating coverage with an underperform rating. That collision we talked about at the beginning, the positive margin story versus the negative demand story, it's not even a fair fight right now. The bears are winning, and the path back to any kind of meaningful growth just looks incredibly difficult from here. Now, for those of you who like a more, shall we say, creative idea, we'd throw out a pairs trade. The thinking here is that Peloton's problems are very specific to Peloton. This upgrade cycle thing, the subscriber numbers. So you'd short Peloton's stock, but at the same time, you'd go long a consumer discretionary ETF, something like XLY. What this does is it basically isolates Peloton's company-specific risk. You're betting that even if the overall consumer is healthy, Peloton will still struggle and underperform its peers. And as you all know, this is not financial advice.